I often get asked by clients, how can I get a vacation home? Everyone seems to want one. It's a pretty common goal, but there's a lot of uncertainty with how to get one. So, whether that's you getting a beach house, or maybe a ski lodge, or maybe you just want to live in the mountains somewhere and have no one bother you, totally cool with me. Derek Mazzarella with Gateway Financial Partners. Please be sure to like and subscribe this video if you found it useful. Today, we're going to talk about how do we get you that vacation home of your dreams. So, what does it actually take? All right, so about 50% of people or more typically have to borrow. If you're that other 50% that just can pay cash, good for you. You don't need my help probably. But let's look at some options because there are some actual pretty big differences between you qualifying for a mortgage for your primary home versus you getting a mortgage for your vacation home. All right, so the first thing we need to look at is what's your credit score? So a typical home, primary home, you need a minimum credit score of 620. Now, with a vacation home, you need a credit score of at least 640. But at that lower amount, you still have to put much more down than a conventional mortgage. But why don't we look at that right now? So a down payment for a normal home usually is about 3% for a primary residence. With a vacation home, you have to put down a minimum of 10%. But if you do that, your credit score has to be at least 680 to do the 10% down. If you want to put down 25%, then your credit score could be as low as 640. So the higher your credit score, the less you have to potentially put down. The other thing we look at is what is your debt to income ratio? So a typical debt to income ratio in a primary residence can be as high as actually 50%. Please don't spend 50% of your income on a house. Okay. With a vacation home, you have to put down you have a debt to income ratio of 45%. So let's take a look at what that actually means. So let's say you have a monthly income of $10,000. Good for you. That means 4,500 of it can go towards debt. So that includes student loans, your current mortgage, a home equity line of credit, the new mortgage. So all of that has to be 45% or less. And depending on your credit score, that number maybe have to be 35%. So these three items are actually pretty related here. So you want to make sure that your credit score is as high as possible, you're able to put down as much as you can, and your debt to income ratio is as low as possible. There's a couple other differences as well. So when it comes to the interest rates are actually about 0.5% to 1% higher than a traditional, primary mortgage. The other thing they look at is you have to typically hold more cash reserves. So typically mortgage companies are going to want to see at least 2, but more likely 6 months of expenses just sitting in cash because they want to make sure that you have some money available on hand in case you were to lose your job or something else happens where you can basically float both properties. Okay, so with mortgages, your credit score has to be higher, your down payment has to be higher, your debt to income ratio has to be lower, your mortgage rates are going to be higher, and you have to have more cash reserves. So who would want a beach house, right? These are just some of the things you're going to have to go through when it comes to having a second home. Now, some other things to consider are going to be one, taxes. Is there actually any tax benefit to having a vacation property? Typically not. I mean, they did increase the SALT deductions or decrease it to a limit of $5,000 if you're, not married, and then $10,000 if you're filing your taxes jointly. So if for whatever reason your primary home is under that amount and this vacation home gets you to that $5,000 or $10,000 number, then there actually is some tax advantage for you. If your current residence is already over either of these amounts, depending on what your situation is, then there's no additional tax benefit Also, if you're not itemizing, so you're just taking the regular deduction, there's no additional benefit for you there either. Um, Two, one other thing to consider is, okay, if I'm going to rent this property out, what does that mean? So that means that your mortgage is now going from a secondary home mortgage to a investment property. Investment properties are a little bit different from a mortgage standpoint, but the biggest benefit of that is that they'll count 75% of your rental income towards your income. So it'll go against that debt to income ratio, and it'll help you with your cash flows in general. So if you're finding yourself in the position where you would like a beach house or you would like a vacation home somewhere, but you just don't meet those other requirements, a way to get in there is to rent out your vacation property either a few months out of the year, a few weeks out of the year, whatever it takes to get you that beach house. One thing to consider though is once you start renting it, you do shift from the second home to the investment home mortgage, where the rates would probably be much higher compared to the once again traditional secondary mortgage. So one thing to keep in mind. But if that means you getting the house and you not getting the house, that's probably worth doing. You just also need to be upfront with it. You can't say, "Hey, look, I'm buying it," and then gonna rent it out later. One of the things that you do get actually from a tax standpoint is if you rent it out less than 15 days, that rental for those 14 days are tax free. So you can rent out your property for up to 2 weeks and not have to worry about paying Uncle Sam. So that, in a nutshell, is how you can go about getting a second home. You want to keep in mind some other items too. So think you've got to furnish it. You're going to have repairs and maintenance on two houses. Who's going to manage it? So there's a lot of other kind of factors to look at outside of just the financial piece of it. How much time you're going to be able to use it. So those are a lot of things you want to consider when looking at a vacation home. But from a financial standpoint, you really don't want to overextend yourself. So if you're looking and say, "Hey, look, I don't have the down payment right now," don't force it. If you don't have the debt to income ratio, try and whittle that down as much as possible. If this is truly a goal, you just want to know, okay, these are my targets and this is how I have to get there. All right. It doesn't matter if you don't get there next year, you maybe get there in 2 years from now, but knowing your targets always helps. So Derek Mazzarella with Gateway Financial Partners. If you like this video, please, once again, subscribe, like it, pass it on to someone.